Bismillahirrahmanirrahim. This is the first video on accrual accounting. This video aims to simplify the concepts of accounting adjustments and help viewers understand their significance in preparing accurate financial statements. In this video, we will explain the revenue recognition principle, when revenue is recorded, and the expense recognition principle, when expenses are recorded. We will discuss why adjusting entries are necessary and highlight the major types of adjusting entries. We will show how to record adjusting entries for deferrals, that is, prepaid expenses, and unearned revenues. We will discuss accruals, that is, accrued revenue and accrued expenses, in the next video. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. In accounting, the periodicity assumption divides a business economic activities into specific time periods like months, quarters, or a year. This allows for easier tracking, analysis, and reporting of financial information within these defined time frames. An interim period is a shorter financial reporting period compared to a full fiscal year. Typically, these periods are quarterly and are mandatory for entities whose stocks or bonds are publicly traded. A fiscal year can begin on any date and last for exactly 365 days. In contrast, a calendar year starts on January 1 and ends on December 31st, following the Gregorian calendar. Accrual basis accounting records transactions when they happen, not necessarily when cash changes hands. Revenue is recognized when services are performed, regardless of when payment is received. Expenses are recognized when they are incurred, not just when they are paid. In cash basis accounting, revenues are recorded when cash is received, and expenses are recorded when cash is paid. However, this method is not in line with generally accepted accounting principle GAAP. Let us look into an illustration. Suppose that Fresh Colors paints a large building in 2013. In 2013, it incurs and pays total expenses, salaries and paints for 50,000. It bills the customer for 80,000 but does not receive payment until 2014. So in the year 2013, if we follow the accrual basis of accounting, we are going to record revenue for 80 and expenses for 50, as this is what they have earned and this is what they have incurred, and the net income is 30,000. However, for the year 2013, under the cash basis, we have only billed the customer, we have not received cash. So revenue will be recorded as 0, and expenses, since we have paid these expenses, we are going to record them. So there is a net loss of 50,000 under the cash basis, and there is a net income of 30,000 under accrual basis. For the year 2014, there is no revenue earned and no expenses incurred according to the accrual basis. So the net income, revenue, or expenses all are zero. However, since we are going to receive this payment in the year 2014, under cash basis, revenue will be recorded as 80,000. They have not paid any expenses in the year 2014, so the net income now is 80,000. The revenue recognition principle states that companies should record revenue in the period when it is earned. For example, if a service company, say a dry cleaner shop, cleans clothes in the month of June but receive the payment in the month of July, so they have cleaned or they have given the service in the month of June and they are receiving the payment in the month of July. Under the accrual basis of accounting, the shop will recognize the revenue in the month of June when the service is provided, not in July when the payment is received. This means that the company records the revenue and accounts receivable in June, although the payment comes later on. So in the month of June, if we record in the place it analyze in the accounting equation, so we are not receiving cash, so that is account receivable. We have already done the job of cleaning, so this is service revenue. So revenue is increasing and account receivable is increasing, although we are not receiving these revenue. In the month of July, we are going to receive cash, so cash is going to increase and this account receivable is going to decrease. The expense recognition principle, also known as the matching principle, aligns expenses with the revenue they help to generate. In simple terms, expenses should be recognized in the same period as the related revenue. For instance, of this dry cleaner shop, if they have incurred salary expenses while providing these cleaning services in the month of June, so those expenses should be recorded in June even if the actual payment is in the month of July. So if the salary is incurred, they are not paying. So the salary expense is going to be minus because it is going to decrease the profits, and now this is a liability and that is salary payable. And this is going to be increased in the month of July. When they are going to make this payment for salary, the accounting equation will be like this. Salary payable now is going to decrease because we are paying, and cash is going to decrease by the same amount. So this ensures that the company's financial statements accurately reflect the cost associated with earning revenues. These are the principles. The economic life of a business can be segmented into artificial time periods for accounting purposes. Revenue should be recognized in the accounting period during which it is earned. Expenses should be matched with revenues in the period when efforts are expended to generate those revenues. These principles are in accordance with GAAP. Now, adjusting entries are needed to ensure adherence to the revenue recognition and expense recognition principle. They are needed to verify compliance due to potential discrepancies in the trial balance, which may lack updated or comprehensive data. They are essential during financial statement preparations, ensuring accuracy and compliance. They include one income statement and one balance sheet account for a thorough validation, and we will look into these when we go for an exercise in few minutes. Adjusting entries are of two types: deferrals and accruals. Deferrals again can be of two types: prepaid expense and unearned revenue. So, prepaid expenses are the expenses paid in advance before they are utilized. Unearned revenue is the cash received before providing the services. We will talk about accruals in the next video. Uh, and under accruals, we have accrued revenue, that is revenue earned but not yet received or recorded, and accrued expenses, that is expenses incurred but not yet paid or recorded. So, in the case of deferrals, the company is paying, either paying in advance, they are paying in advance, or they are receiving. Either they are paying in advance or they are receiving in advance. If they are paying in advance, that is number one, prepaid expense. If they are receiving in advance, that is number two, that is unearned revenue. Prepaid expense is an asset and unearned revenue is a liability. Okay. Now, this trial balance is from my previous video. If you want, you can look into the accounting equation, and this is the trial balance of Syra Corporation, and we are going to look into the adjusting entries that may be required for this business. And as I have already said that in this video we are going to talk only about the deferrals. So deferrals are expenses or revenues that are recognized later than when cash was initially exchanged. They include prepaid expenses and unearned revenues. We have already talked about analyzing, generalizing, posting, and trial balance in the previous videos. And in this video, we are going to look into generalizing and post adjusting entries for deferrals only. For accruals, we are going to talk about in the next video. So companies, they record prepaid expenses for cost that span multiple accounting periods, like insurance, supplies, rent, etc. And these expenses expire gradually or with use. Prepaid expenses are recognized at financial statements preparation with adjusting entries made to reflect current period expenses and update assets account. Adjusting entries for prepaid expenses increase the expense account and decrease the asset account, ensuring accurate financial reporting by correcting overstated assets and understated expenses. So, in the case of prepaid expense, just keep one thing in mind that the assets are overstated and expenses are understated. And to correct them, we have to increase the expense and we have to decrease the asset account. And let us look into some examples in this regard. Now, One is about the supplies. So when a company buys supplies, it adds to its assets account, and let me show you this. Um, you can see that there is a supplies account that is showing a balance of 2,500 in the trial balance. And now what happens is that throughout the period it uses these supplies without immediately expensing them. At the period's end, the company checks the remaining supplies. The difference between the initial supplies balance and the actual cost shows the supplies used as an expense during this period. So in the trial balance just now, we have seen that the supplies was for 2,500. This was the initial supplies balance, and the actual balance in this example, okay, their supplies costing 2,500 on October 5. Sarah recorded the purchase by increasing debiting the asset supplies. This account shows a balance of 2,500 in the October 31st trial balance. An inventory count at the close of the business on October 31st reveals that 1,000 of supplies are still on hand. So we have the supplies of still on hand for 1,000. That means 1,500 has been consumed. Supplies for 1,500 and has been consumed. So there is a decrease in supplies by 1,500, and there is an increase in supplies expense by 1,500, and that is what we mean over here, that expenses are going to be adjusted by increasing the expenses and decreasing the asset. uh, let us see, let us talk further about it. So the expense, supplies expense has increased by 1,500 and supplies has decreased by 1,500. So increase in expense, we are going to debit the expense, and decrease in asset, we are going to credit the expense, the supplies. So supplies expense is debit and supplies is credit. We have the balance of 2,500 in the trial balance. Now we have consumed 1,500 of this. So the actual balance at the end of the period is 1,000 and not 2,500 as shown in the trial balance. For the supplies, yes, the supplies expense has increased by 1,500. So we will look into few more and then see what is the impact on the ledger and the trial balance as we progress. So let us look into another illustration. This is another example of prepaid expense, that is the insurance. Now, when companies buy insurance, they initially record the prepaid premiums as an increased debit in the prepaid insurance asset account. And if you can remember, let us see the trial balance again, and you can see that the prepaid insurance is 600 at the beginning. So this was the Sarah Corporation has paid 600 for a 1 year fire insurance policy, and obviously because this is on October 31st, they have paid this on October 1st. So prepaid insurance would be debited. Now as the time passes, the prepaid insurance diminishes. Now if it is for 1 year, so we will divide by 12, and this is for 1 month only. So 1 month means 50 riyal. 600 divided by 12. So at the end of each financial year, the company has to adjust this record. So once again, the insurance expense is going to be debited. The insurance expense is going to be debited, and then the prepaid insurance is going to be credited to make the adjustment. So the adjustment will reduce the prepaid insurance asset and accounts for the use of insurance cost as an expense in the financial year, and that is what we have done over here. Insurance expense is debit and prepaid insurance is credit. Expense is increasing and asset is decreasing. This has been explained again. So you see the asset has decreased and the expense has increased. Increase in expense is debit, decrease in asset is credit. So insurance expense is debit, prepaid insurance is credit. Now when we prepare the prepaid insurance account, 600 is from the trial balance. Now prepaid insurance is credit by 50 and we have the actual balance on 31st October as 550 and not 600. The insurance expense has increased now on 31st by after this adjustment by $50 or reals as the case may be. Okay. Now, companies categorize long lived assets like buildings, equipment, or vehicles as assets, not expenses, because they serve over many years and are recorded at their cost under the cost principle. Depreciation allocates a part of the asset's cost as an expense during each period of its useful life, ensuring compliance with the expense recognition principle. Depreciation adjusts for the use portion of the assets cost during the period and shows the remaining unused cost at the period's end. It's about allocating cost over time rather than reflecting the asset's actual change in value. So let us look into an illustration again. Here the Sarah Corporation assumed that depreciation on the office equipment is 480. So for 1 month it will be 12 divided by 480, that is 40 per month. Now once again, this is interesting for the asset. You can see that uh, instead of reducing the asset account, we have credited the accumulated depreciation equipment, and this is called a contra asset account, and this is offsetting the equipment asset. So this tracks total depreciation over the asset's life. So to balance the equation, depreciation, we put it in the accounting equation. So depreciation expense is increasing, and at the same time, uh, so increase in the expense will decrease the stockholder equity, and accumulated depreciation equipment, this increases by 40 while equipment remains 5,000. So equipment will remain 5,000 and we will be having an accumulated depreciation. This is a contra entry and this will reduce the asset by 50, by 40, sorry, by 40. Okay, so this is how you see accumulated depreciation is decreasing the asset, and this is going depreciation expense is decreasing the stockholder equity. Decrease in stockholder equity is debit, and in decrease in asset is credit. So depreciation expense is debit and accumulated depreciation equipment is credit. Now I would like to show you, it was for the trial balance. uh, Equipment is for 5,000 and this remains 5,000. So when we open the equipment account, the equipment account on 31st of October still remains the same. Why? Because for fixed assets or long-term assets, we are going to have a contra entry by the title accumulated depreciation equipment, and obviously you can see that accumulated depreciation is credited by 40 and there is an increase of depreciation expense by 40. Okay. So you can see that this is a contra asset They appear just after the account it offset equipment on the balance sheet. Book value is the difference between the cost of any depreciable asset and its accumulated depreciation. Equipment was 5,000, accumulated depreciation was 40, so the book value of the equipment is 4,960. So if we summarize about prepaid expenses, these are the examples like insurance, supplies, advertising, rent, depreciation. In all these cases, we are going to pay in advance, and the reason for adjustment is prepaid expenses recorded in asset account have been used. So assets are overstated, expenses are understated. To make the adjustments, expenses are debit and the assets are credit. But in the case of depreciation, we don't credit the asset, rather we use a contra asset, that is accumulated. The title is accumulated depreciation. Okay, so so this is all about the prepaid expenses. And if you can recall that when we say deferrals, there are two. We have the prepaid expenses we have talked just now, and now we are going to talk about the unearned revenue. So companies use the unearned revenues, that is liability account, to track cash received before revenue is earned, like rent received in advance, or magazine subscription received in advance, or airline ticket received in advance. All these are examples of unearned revenues. We are receiving cash before revenue is being recorded, and this is a liability for the business and not a revenue. So when a company gets paid for future services, it credits the unearned revenue account to show the liability. Assets is equal to liabilities plus stockholder equity. So unearned revenue is a liability, and this is increasing, and increase in liability is debit, and revenue is recognized when services are provided. So adjusted during the period, it may be not necessary on a daily basis. So adjustments record revenue earned and update the liability. This decreases the liability and increases the revenue. So if we receive in advance, unearned revenue is increasing, and because we are receiving in advance, so cash is also increasing at the same time, and we have to make adjustments. So when we make adjustment for unearned revenue to update, so this will obviously decrease the liability, and decrease in liability is debit, and the revenue is going to increase once we have given the service, so revenue is going to be credited. So this is what we have to do, and let us see and look into an example. Now Sarah Corporation receives 1200 on October 2, and I would like to go back to the slide we have, to the trial balance rather, and this is uh, unearned revenue is 1200. On October 2, from R Knox for guide services for multi-day trips expected to be completed by December 31st. Unearned service revenue shows a balance of 1200. I have shown you the balance in the trial balance. From an evaluation of the service Sarah performed for Knox during October, the company determined that it has earned 400. So if they have earned 400, that means that our liability from 1200 decreases by 400, and decrease in liability is debit, and obviously we have earned, so this is a revenue, and increase, this will increase the stockholder equity, and increase in stockholder equity is credit. So unearned service revenue is debit and service revenue is credit. So now the adjusted unearned service revenue will be 1200 minus 4, 800. So unearned service revenue on 31st October should be 800 and not 1200, representing future guide services. Now service revenue reflects total revenue earned in October, as I can show you here. We go. So the unearned revenue decreases by our liability decreases by 400, our revenue increases by 400. So unearned service revenue is decreased, is debited by 400, and service revenue is credited by 400. Now if you look at the service revenue in the trial balance, service revenue is 10,000. But this has to be adjusted because revenue has been credited. So service revenue is 10,000 in the trial balance, and now it is credited by 400. So we have a total revenue of 10,400, and unearned service revenue is debit by 400. So now we have a balance of 800. Okay. So unearned revenue, the examples may be that we have received cash for rent in advance, for magazine subscription, customer deposit for future services. So reason for adjustments are unearned revenue recorded in liability accounts are now recognized as revenue for services performed. Liabilities are overstated, revenue is understated. So if it is overstated, liabilities has to be debit, and if the revenues are understated, revenues has to be credited to get the correct number or the value. Let us look into one illustration also. The ledger of Hammond Incorporation on March 31st include these selected accounts. Before adjusting entries are prepared, we have prepaid insurance, supplies, equipment, and then we have accumulated depreciation and unearned service revenue. Analysis of the account shows the following: insurance expire at the rate of 100 per month. So insurance expires at the rate of 100 per month. This is a prepaid insurance. So there will be for adjustment, insurance expense has to be debited and prepaid insurance has to be credited. Now supplies on hand is 800. Now if you look into the supplies is 2,800, and now on hand is 800 with us. That means 2000 has been consumed. So supplies expense is debit and supplies is credit by 2000. Then the equipment depreciates for 200 per month. So that is easy. Depreciation expense is debit and accumulated depreciation equipment is credit by 200. So the accumulated depreciation is going to be credited by 200 in this case. Now during March, services were performed for one half of the unearned service revenue. Now unearned service revenue is 9,200 and one half will be 4,600. That means our unearned revenue, the liability decreases by 4,600. Decrease in liability is debit, and we are earning, so our revenue is increasing by 4,600. So this completes the first video on accrual accounting, where we talked at length about the deferrals. Inshallah, in the next video we are going to talk about the accruals. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.